Good afternoon, everyone. I hope my audio is clear and I'm just sharing the screen. And just let me know if the screen share is also visible or not. So today we got a hands-on CA final RTPs, also CA inter, right? So we'll be discussing financial reporting RTP. Now this RTP will help us understand what kind of MCQs also would be tested in the examination. Now I have gone through the entire RTP, and the case-based questions are also, or the MCQ questions are also nothing but existing questions modified with options. So that actually makes our life slightly easier. But on the other hand, these questions are slightly lengthier compared to a 2-mark question. Okay, so that is one thing we have to be careful about. As we discuss, I will be telling you some tricks and tips on how can we answer MCQs quickly or in a faster way. That is one thing. I hope all of you are able to see my screen. If yes, please put down in the comment that yes, you are able to see the screen. And as we discuss, whenever you have any doubt, please feel free to ask. And even if you're watching it after the live streaming gets over, and then also if you have any doubt, please feel free to ask, right? So now here we have the RTP on the screen. So let's start with the first question, which is a case-based scenario. Now I have a small, problem with this case-based scenario. It is actually not a proper case structure. It is more like 4 different questions forcefully they have combined into a single question, and they have said, okay, this is a case scenario. Okay, so let's see what it means. And a lot of these questions, as we discuss, you will see that we already have discussed similar questions in the class, right? So that way it would be slightly easier for you to handle the questions in the examination. So without wasting any more time, let's get onto the discussion of the RTP financial reporting May 23. First scenario, case scenario 1. FL Limited is a company which manufactures aircraft parts, engines, so and so for multinational companies, so and so. Following are the details. Now, this part, what is important is the company name. Other details are not very important. So, as you read questions, you should get into a habit as to what is important, what is not important. Now, I'll just scroll through the case. You can see there is case number 1, very long. A very long scenario, then case number 2, then case number 3. So now, if we study this in detail, we may not have sufficient enough time to read it fully and also understand the questions. Please understand, these 3 you will get it for 10 marks, and we have to utilize our time in a very fruitful way. So what we can do is, in such kind of questions, when you have longer questions, what is the question? First one is talking about which of the following items need to be capitalized. So first one is talking about capitalization. Second, calculate the company's associate Flynet Limited cash flow from operations. So whenever you have these smaller direct questions, first read the requirement and then go back to the case. If you study the case, by the time you come to the question, and you will anyways forget everything. So this is a direct question. Which of the following needs to be capitalized? Okay, we will figure that out. Calculate the company's Flynet cash flow from operations. We'll figure that out. Now here this is a slightly longer question. You can leave it for a subsequent. Then compute the total amount to be charged to the statement of P&L with respect to production line for the year ending 31st March, and the balance of provision for dismantling cost to be carried to balance sheet. Again here you have to compute something to be charged to P&L and dismantling cost. Compute the cost of production line to be capitalized initially on 31st May of year 2. Now if you see, first they are saying capitalized, what capitalization? Cost of the production line. Then amount to be charged to statement of P&L is in the 4th question. Now the problem what will happen is, if you read the case first and then if you start solving one by one, first you will look at 4, but whereas we can compute 5 first and then we can come back to 4. So once we have understood this requirement, then is when you should go back and see the case study, right? So quickly we have seen the requirement. Again, don't spend too much of time in understanding or in breaking down the requirement immediately. Okay, those of you who are not able to find RTPs on the website, what we'll do is, I will, after the session gets over, we'll upload it and we'll share the link with you. Okay, it is there after login, or in the old portal. What you can do is, I'll just show you where is it available. So here you have new scheme of education and training. Under that you have at last revision test papers, which you can have a look at it, right? So coming back to our discussion, On 1st of April of year 2, the company began the construction of a new production line in its aircraft parts manufacturing shed. When did they start? 1st of April of year 2. Okay. Cost of basic material is given, recoverable goods and service tax incurred, but not included in the purchase cost. Now, what is this recoverable goods and service tax? Basically, this is your GST on which input is available. Okay. This is your GST on which input is available. Employment cost of the construction staff for 3 months till 30th June. When did we start? 1st of April. This is given for 3 months. Similar question, if you remember, is solved in the class. It is given in the ICI material. They have just converted that and created a case study. Okay. Other overhead directly related to the construction, 0.90. Payment to external advisors relating to the construction, 0.50. Expected dismantling and restoration cost, 2. This has to be valued at present value. Please remember, the last question has asked us what is the initial amount to be capitalized. So that thing we have to keep in mind when we are solving this particular question. What is the amount to be capitalized, right? Then production line took 2 months to make ready for use and was brought to use on 31st May, which means out of these 3 months we have to take only 2 months. And then when we charge depreciation, it will be from 1st of June till 31st of March. That is a total of 10 months. That is how you have to read the questions. Then other overheads were incurred during the 2-month period ended 31st May. They included an abnormal cost of 0.3 lakhs caused by major electrical fault. And we know that abnormal cost we should not consider. Okay, done. Production life is expected to have an economic life of 8 years. After 8 years, FL Limited is legally required to dismantle the plant in the specified manner and restore its location. These are basically your restoration related cost. What do we do? Present value will add it to the cost. Okay. Amount of 2 lakhs included in the cost estimate is the amount that is expected to be incurred at the end of the useful life. The appropriate discount rate is 5%. Present value is 0.68. So that is given. So what we will do? 2 lakhs is given into 0.68. Whatever is the number, 68 into 2 is 136. So 1.36 is what we have to add. For years, 4 years after being brought into use, production line will require a major overhaul to ensure that it generates economic benefit for the second half of its useful life. Estimate cost of the overhaul at the current prices is 3 lakh. Now this is given because you have to depreciate the major overhaul over its life of how much? They have given the life of 4 years. So within 4 years we have to depreciate. Now after we read this question, what all do we need to answer from this? We have to answer the first question. We have to answer the value to be charged to P&L and also the carrying amount and the cost, right? So that is one. I will not touch upon question number 2 now and question number 3 now because these are independent scenarios. Okay, these are independent scenarios. So first, which of the following items need to be capitalized in determining the production line? Do we take abnormal cost? No. Recoverable GST? No. Initial estimate we take, but not 2 lakhs. We take 1.36 lakhs. So option D. My mistake here. So option D is the right answer. You will get 2 marks. It is so simple, but you have to spend a lot of time. Means you have to be faster. You have to be quicker in analyzing the question. Okay. Then associate with, that is the third scenario. We'll consider it later. Then compute the total amount to be charged in statement of P&L and compute the cost of production line to be capitalized. Now always remember, first what we will do? First we'll capitalize. Correct? First we'll capitalize and then we will charge the amount to P&L. Technically speaking, this has to be question number 4 and this has to be question number 5, but they are flipped. No problem. Compute the amount to be capitalized initially on 31st May. Now one very important thing, one very important trick that I am telling all of you. No need to prepare detailed solution like you do in a 5 mark or a 6 mark question. For example, I'll just show you. What ICAI has done is, so now if you see here, for 4 and 5, they have done a detailed calculation. Are we required to do this detailed calculation? Not required. If you are able to do it in a rough manner also, that is more than sufficient, because what is important is the final answer, not your working. In objective type question, it is your final answer that is relevant, not your detailed working. Okay. So hence what I suggest to all of you is that you should try to do it in a as quick and dirty manner as possible. Okay, so no need to beautify your answer sheet. You can do it as quickly as possible. Now, what they have asked us, cost of production line to be capitalized initially. So let's come back to the question. Now, when we calculate cost of production line, what all do we consider? We will consider purchase cost, yes, so 10 lakhs. So you can take your calculator alongside 10 lakhs, okay. GST will not consider. Employment cost, this is for 3 months, we have to take for 2 months. So 1.2 into 2 divided by 3, this is 0.8. I hope the writing is clear. Oh, I am hiding up the writing, just a second. This is a bit better. Okay, so 0.8. So 1 is 10, simultaneously add. So you can do 10 m plus 1.2 into 2 by 3 m plus. Other overheads directly related to construction 0.9. Out of that 0.3 is abnormal. So 0.6 m plus. Payment to external advisors we will consider 0.5 m plus. And 2 we will not consider. Present value is what? Into 0.68. That is 1.36 m plus. And you can do memory recall. The answer, whatever you get, that answer will be the amount to be capitalized. So 10 plus 0.8, 10.8 plus 0.6, 11.4, 11.4 plus 5, 11.9, 11.9 plus 1.36, 11.9 plus 1.36. If I do 12, 13, 13.26 is the answer. So the fifth question, the answer is option number A, 13.26. So here also you can score 2 marks. You will not be able to, or even if you want, you should not be losing marks in this question, right? I hope it's clear. If you have any doubt, any questions, please feel free to interrupt and ask the questions. Okay. Then compute the total amount to be charged to statement of P&L with respect to production line for the year ending 31st March and the balance of provision for dismantling cost carried to the balance sheet. Now here what they are asking. First they are asking, one is your depreciation, okay, because you have to calculate depreciation, that is one part. Then second part what they are asking is, one is depreciation, second part we have this dismantling cost with respect to production line. On this there will be interest. So one, we have to calculate depreciation, second we have to calculate your what you call interest. Now depreciation also, out of this 13.26 lakhs, your overall is 3, which has a useful life of 4 years, and remaining 9.26, sorry, 13 minus 3 is 10.26, remaining 10.26, this has a useful life of 8 years, this has a useful life of 4 years. And please remember, we have to calculate depreciation for 10 months. So what you will do, 3 divided by 4 into 10 divided by 12, that is for the overhauling part. You can calculate on your own. Then 10.26 into 8 into, sorry, divided by, just a moment, sometimes it happens, 10.26 divided by 8 into 10 by 12, that is for the other part. That put together will be a depreciation. But your answer should not stop there. Your answer should be also including the interest part. Interest on what? Interest on 1.36 lakhs. Now what is the interest on 1.36 lakh? 1.36 lakhs into 5 by 100, 5% into 10 months divided by 12. So this is one part. Then this is the second part of depreciation, and this is the third part which is related to depreciation. All of this you should calculate, and you should say, okay, this is the total amount. That's the first part. Then they have also asked balance of provision for dismantling cost carried to the balance sheet. What is that? That is your 1.36 plus interest. What is the interest? 1.36 into 5 divided by 12 into 10, sorry, 1.36 into 5 divided by 100 into 10 divided by 12. Once you do this, 1.36, so if I have to calculate 1.36 into 5% into 10 divided by 12, if I do, it is 0.056. So 1.36 plus 0.056 or 0.06, that is 1.42. So now I can see here, one option is here, one option is here, 1.42, 1.42. one of these two, 1.7 and 1.76, will be correct for the total expenses. That I think you can do it on your own. It is a direct or a straightforward question. Okay, so that is the part related to depreciation, 6 marks question. And please remember, we have spent about 12 to 13 minutes. Okay, now in examination, there will not be need, there will not be a need to analyze or explain or write down so much in detail. So try to finish this 6 marks in 8 to 9 minutes as fast as possible. Now then comes, calculate the company's associate fly net cash flow from operations. Okay, so now what is that related to? Let's see. This is related to this Flynet. FL Limited has an associate company, Flynet Limited. Following are the information of Flynet Limited for the year ended 31st March of year 3. What are we required to do? We are required to calculate cash flow from operations. Okay, we are required to calculate cash flow from operations. So, what they are given? Net income after taxes 120. Okay, so they are given after taxes. So we will have to adjust back the taxes. Anyways, we'll have to adjust back the taxes, but again, tax payment is deducted to arrive at net cash flow from operations. So whatever you do, the net impact will be 0. So net profit after taxes 120. Decrease in account receivable. If there is a decrease in account receivable, what do we do? If there is a decrease in account receivable, means we have received more, so we will add it. So we'll add this. Depreciation is a non-cash item, you will add this. Increase in inventory is opposite to this, so you will subtract this. Increase in account payable, you will add this back. Decrease in waste payable, you will reduce this. Tax charge for the year, deferred tax liability. Now deferred tax liability, please understand, is a non-cash item. Okay, because deferred taxes, you don't actually pay any tax on that. So this is a non-cash item, you will add back. Profit from sale of land, this belongs to some other item, so you will subtract it. So no need to prepare a statement. As you read the question, figure out that, okay, I have to plus this minus this. That's it. So 120 plus 20, 140, 140 plus 25, 165, minus 10, 155, plus 7, 162, 162 minus 5, 157, 157 plus 15, that is 172, 172 minus 2 is 170. 170. So let us see, do we have that option? We have 170. Option B is the right answer. So this we could solve in 2 minutes time, and that will give you 2 out of 2. Cannot make mistake here, right? So I hope you are able to understand how to address or how to handle these kind of questions in the examination, right? Then moving on to the next part, question related to associate. There are 2 more aspects. One is related to associate, and so this associate we have completed. Another one is accounting treatment to be done for some legal action. So let us go to the third scenario. During the year 31st March, FA Limited provided consultancy services to a customer regarding the installation of a new production system related to the aircraft parts. The system has caused the customer considerable problem, so the customer has taken legal action against the company. For the loss of profit, damages claimed is 1.6 lakhs. That they have claimed. Legal department considered that there is a 25% chance that the claim can be successfully defended. Means what? 75% chance that we will lose. Means what? It is probable, right? It is probable. Now, that is the first part. Probable because greater than 50%. Probable, we have to create a provision. The legal department further stated that they are reasonably confident the company is covered by insurance against these type of loss. Now please remember, insurance receivable, we have discussed this in class also, is an independent part. Insurance receivable is an independent part, and insurance receivable is an independent part that has to be considered separately under contingent asset. The accountant feels nothing needs to be provided for the company. So let's see the question. See, first is, this is a scenario where a case is filed. Means there are 2 outcomes. One is win, one is loss. Now whenever there are 2 outcomes, we will take the most likely outcome, loss. That is 1.6, we have to provide it freely. So the question is, nothing needs to be provided, this is wrong. Provision of 1.6 lakhs should be recognized, this is correct. Provision of 0.4 lakhs, no, because It has to be based on most likely outcome. Okay. Contingent liability is not the correct answer. So the correct answer is 3B. Right. So now, if you see, we have spent about 20 minutes on this live, and we have already we discussed much more in detail. So if you manage your time properly, this 10 marks question can be completed in about 15 minutes time, and out of this 10 you should try to score 10. Okay, that is should be the end objective. Now moving on, second case scenario, car manufacturing company. Again, first quickly glance to the requirement. First, at what amount shall HSL carry its investment in NM Limited in consolidated financial statement? That is one. How should HSL account for trade discount, cash discount and voucher? What shall be the accounting treatment of directly attributable expenses issued in connection with the issue of compulsory convertible debentures? Then this slightly elaborate question, will come to it later. With respect to SPA entered by HSL, determine the date when HSL gained control over FM. So these are the 5 questions. Okay. So now again, let's read the case scenario. During the year, HSL has entered into many transactions, details of which are given below. So again, they are trying to create a case, but they are again giving multiple transactions independently. Okay. With the intention to expand, HSL has entered into a share purchase agreement with the shareholders of FM Limited to purchase 30% stake in FM Limited as on 1st of June at a price of 30. Okay, so 30% stake is purchased on 1st of June. As per the terms of share purchase agreement, HSL has an option to purchase an additional 25% on or before 15th June at a price of 30. Means here you have an option. You can buy the shares. You have an option. You can buy the shares of which company? The other company on or before 15th June. Means you already have an option. Okay. Now please understand, whenever we talk about control, we need to see whether the company can exercise some existing options and get the control. Right? This we have discussed in class as well. Similarly, selling shareholder has an option to sell additional 25% stake in FM Limited on or before 15 June at a price of 30. Okay, so if the company has to buy, if the company doesn't buy, the seller can sell. The decision on relevant activities of FM Limited are made in AGM, EGM. Resolution in AGM, EGM is passed when more than 50% votes are cast in favor. AGM, EGM can be called by giving 21 days advance notice to all shareholders. Now, what is the cutoff date? 15th June. Means to approve this transaction, there was an AGM held 21 days earlier. Means the transaction is already approved by the shareholders. It is just that the company has to exercise either the buying or the selling company. Right? That is the first part. During the year, HSL. So here it is about HSL and FM. During the year, HSL issued compulsory convertible debentures on a private placement basis for 100 lakhs. Now CCD are what? Compound financial instrument. Each CCD is convertible into 5 shares at the end of 4 years from the date of issue, and an annual interest is payable at the rate of 6%. An initial recognition, HSL recognized a liability component of 20,79,063, and HSL also incurred expenses of 2 lakhs in connection with the issue of the instrument. Nature of expenses includes fees paid to legal advisors and other aspects. Now what has happened? A compound financial instruments has been issued. Compound financial instruments has been issued, and they have already given what is the liability component and what is the balance component, which is the equity component, and we have the transaction amount. Okay, that is the second component. Then HSL acquired 40% stake in NM Limited as at 1st of January for 8 lakhs and classified the investment in NM Limited as an associate. So for 40% in NM Limited, which is an associate. Okay. As at 1st of January, carrying amount and fair value of plant and equipment is 3 lakhs and 5 lakhs respectively. Means what? You will do an adjustment of this 2 lakhs fair value difference and subsequently provide additional depreciation. Okay. Remaining useful life is 5 years, that is 20 quarters. Now why they have given that? Because you have acquired on 1st of January and you need 31st of March. NM Limited generated a profit of 50,000. So how do we value in associates? You will take the cost of investment. To that you will add the profit earned and any fair value adjustment that is to be done, you will do it. While selling a car, HSL provides a trade discount of 1% on the sale price, which is mentioned on the invoice. HSL provides a credit period of 7 days to its customer. However, if paid upfront, HSL gives an additional cash discount of 2%. HSL also provides a voucher worth 500 which can be used as an apparel store. So we have to see what is the question. First, at what amount HSL shall carry investment in NM Limited in its consolidated financial statement as on 31st March of year 2. So first one is asking, in the consolidated financial statement, what amount shall HSL carry? Which investment? Investment in NM Limited. Now please note students, when there are multiple questions, sometimes you might get confused as to what is the question asking. Now where is NM Limited? NM Limited is here. It is an associate. How will we value it? First, you will take 8 lakhs. To that, you will add your share of profit. What is our share of profit? 40% of 50,000. 40% of 50,000. So what you will do? 8 lakhs plus 40% of 50,000. So 8 lakhs plus 20,000. 8 lakh 20,000. Then there is an adjustment because of additional depreciation. What is the additional depreciation? 3 lakhs to 4 lakhs. 2 lakhs is the difference. This is for 20 quarters. For 1 quarter it is 10,000. Right? Of this 10,000, what is our portion? 40%. So this extra depreciation of 4,000 also you will adjust. So that will give you 8 lakhs plus 2, 8 lakh 20 minus 4, 8 lakh 16,000. So the answer is 8 lakh 16,000, option number C. You might incline to choose 820, you should not do. And sometimes you may do 820 minus 10. This also you should not do. 816 is the right answer. Okay. Then, how should HSL account for trade discount, cash discount and voucher? Now please remember, trade discount you will reduce from the transaction price. Cash discount also is immediately provided at the time of sale. This also will reduce from the transaction price. Then, voucher has to be redeemed at another apparel store. Voucher will not be redeemed at our store. So that also should be reduced because you are giving voucher worth 500 to the customer, right? So these three things what you are giving, the consideration payable to the customer, what we say, that you will reduce from the transaction price. So trade discount, cash discount and value of the voucher shall be reduced from the transaction price. Then, what shall be the accounting treatment of directly attributable expenses 2 lakhs incurred in connection with issue of compulsory convertible debentures? So we have issued CCD. When we have issued compulsory convertible debentures, there are two components. One is debt component, another one is equity component. Now this transaction of 2 lakhs will be split between debt and equity in their respective ratio. So what you can do? 2 lakhs into whatever is the debt component divided by debt plus equity. So debt plus equity is your 100 lakhs. Same way, 2 lakhs balance amount into debt into equity divided by 100. Like this you can do, and you can do the split. Okay. So if you have to do the split, 2 lakhs and it is 2079,063. So 2 lakhs into 2079,063 divided by 100 lakhs. 1, 2, 1, 2, 3. That gives us 41,581. So we have 41,581 from one portion and remaining from the other portion. None of the other options have this. So once you calculate 41,581, you can say option C is the right answer. No need to compute for equity separately. Then, with more acquisition at the year end, HSL has investment in 2 subsidiaries, 3 associates, 1 joint venture. Which of the following statements is correct in relation to accounting of this investment in separate financial statement? Now, when we talk about separate financial statement, we are referring to Ind AS number 27. Now, under Ind AS 27, what does HSL has an option? HSL has an option to measure those investments either at cost or in accordance with Ind AS 109. So, which option gives us that? All at cost? No. Option to account for investment in associates and joint ventures using equity method of accounting and carry the investment in subsidiaries at cost. Now, please remember, equity method of accounting is followed in CFS, not in separate financial statement. So, this is also wrong. HSL has an option for each investment to measure either at cost or in accordance with Ind AS 109. This can be correct. HSL has an option to measure all such investment either at cost or in accordance with Ind AS 109. The option is available for each category. So, this is the correct answer. This is incomplete. It has to be done by each category of investments separately, right? So that is the answer. Then, With respect to share purchased entered by HSL, determine the date when HSL gained control over FM. When did we purchase? 1st of June. By when can we exercise the option? 15th of June. Now the question is, when do we get control? Please remember, AGM has happened. On 1st June we got some stake. Before 15 we can exercise. So to determine the control, we will see whether we can exercise now. Can we exercise? Yes. If we can exercise, then 1st of June itself becomes the date of acquisition. Right? So that is how we will handle MCQs in the examination. I hope you are able to understand. If you have any doubt, please put down in the comment box and I'll be more than happy to address them. Now let's move on to the next part on business combination. Just give me a minute to charge the pencil. Just that the pencil gets charged and then we can start again. The next question that we will be discussing is on Ind AS 103 on business combination. Okay, so let me just on 1st of April of year 1, Pride Limited acquired 30% of the ordinary shares of Famous Limited for 4,000 crores. Pride Limited accounts for its investment in Famous Limited using the equity method as prescribed under Ind AS 28. That is, initial cost plus share of profit minus losses, etc. On 31st March, Pride Limited recognized its share of net asset changes of Famous Limited using equity method accounting as follows. Okay. Share of profit added, share of exchange difference in OCI, share of revaluation reserve of PP in OCI. So all of this gets added. Carrying amount of the investment in the associate on 31st March is 4425. That is this plus 4000. On 1st of April, Pride Limited acquired remaining 70% of Famous Limited for 12,500 crores of cash. When did they acquire? 1st of April. Now, when there is a fresh acquisition, what do? We will take the existing consideration. We will take the fair value of this investment and then we'll compare that with the fair value of net asset to determine goodwill or bargain purchase. Following additional information is relevant. Fair value of 30% stake, 4,500. What is the carrying amount? 4,425. So 4,425 to 4,500, 25 is the gain. Fair value of net identifiable asset, 15,000 crores. So 12,500 plus 4,500 and 15,000 crores relevant for calculation of depreciation. You are required to determine the acquisition date for Pride Limited. When will be the acquisition date? We have purchased on 1st of April of year 2. So the acquisition date accounting for the subsidiary will be 1st of April of year 2. Okay, that is when the controlling interest is acquired. Determine the gain on previously held interest in Pride Limited and suggest the accounting treatment on acquisition date as per Ind AS 103. Now, previously held gain. What is the previously held gain? If you see, carrying amount is equal to 4,425. Fair value on the date of disposal, this date of additional acquisition is 4,500. Right? So 4,500 minus 25 is 75 crores. This is the gain on existing fair value of net assets. Okay, that is the first thing. Then $75 is the gain on the previously held interest. Then they have also said that you have taken exchange difference in OCI and you have taken revaluation reserve in OCI. Now, revaluation reserve will continue to remain in OCI. Okay, so that part will not be changed. But exchange difference, whatever is there in OCI, okay, which is unrealized gain, this will also be transferred to the P&L. So that amount of unrealized gain of 50 crores which is remaining in OCI exchange difference that also will be transferred to P&L, because now it is no longer an associate, it will be held as a subsidiary. So this reserve, this part of 50 crores will also be transferred to P&L. So that is the amount to be recognized in P&L. Then compute the amount of goodwill arising on acquisition of Famous Limited. Now what is the goodwill value? Goodwill value, if you see, fair value of net assets, they are mentioned to be 15,000 crores. Purchase consideration paid 12,500 crores. Fair value of existing stake 4,500 crores. So 17, this is 17,000 crores as compared to 15,000, goodwill comes to 2,000 crores. So goodwill is 2,000 crores. Very simple and straightforward question. Right. Now, pass the journal entry on the acquisition date. Now on journal entry on the acquisition date, what we will do is, we will incorporate the net identifiable assets, that is 15,000 crores. Okay. We will recognize the goodwill of 2,000 that we have calculated. So debit 15,000, debit 2,000. Then we will de-recognize the existing stake that we hold 14,4425, that is carrying amount in the books for the associate, that we will de-recognize, and whatever is the gain or loss will be recognized in the P&L, and we will also do the reclassification of your revaluation reserve, which is lying in OCI. So basically what we will do is, all the existing component will de-recognize. So let me pass the entry for that. We will debit net assets at 15,000 crores, because we are now incorporating the asset. What are we giving out or what are we giving away? We will credit investment in associate at the carrying amount of 4,425, because that is no longer needed. Then we will credit bank or cash by how much? By the amount that we have paid, 12,500, because that is also going out of the business, right? Then we have goodwill, we will debit goodwill by 2,000, because on date of acquisition we need to recognize goodwill. Then we will recognize the gain in P&L, and this revaluation reserve also will no longer be in OCI. This will also be transferred to retained earnings, because once we acquire the subsidiary, all of these existing balances in OCI becomes irrelevant for us. So what we will do is, we will debit OCI by the amount of revaluation reserve 25, and we will also debit OCI by 50. Why? Because this 50 is the foreign currency translation reserve, which has to be transferred to P&L, and this has to be transferred to retained earnings. Then we will credit what? We will credit P&L by this 50 and gain. So 50, and we had calculated gain 4,425 and 4,575. So 125 will be credited to P&L, and the balance amount that is left over, that will go to retained earnings, which is basically your 25 of PPE. So this is the journal entry that you will pass at the time of initial acquisition. Okay, then. So this is the 12th question. We are at 12th question now, and this question is from the latest, which is latest addition to the syllabus, professional and ethical duty. For this, you need to have a good understanding of audit as well. Astra Limited is a listed entity which operates in the defense and fiber optic sectors. It supplies fiber optic cables and racks in the domestic country. This activity is only a trading activity for Astra Limited, as it procures goods from pre-approved suppliers and after inspection sells the goods to IT companies. So Astra Limited, listed entity, supplies these cables. It's a trading activity. The sale contract requires Astra Limited to deliver these goods to the IT company's location, that is delivery at site. So you have to deliver that to the location. Payment terms are 30 days after the invoice date to Astra Limited. Miss Suparna Das Gupta, a chartered accountant, has recently joined Astra Limited as head of finance. The COO, also the executive director of Astra Limited, is Miss Padmaja Srinivasan, a mechanical engineer with an MBA from Harvard University, who rose through the ranks through her excellent skill in project management, marketing. So basically, this information is to be forgotten unless the question asked it, or there is a question based on this subsequently. Her remuneration includes a bonus computed as a percentage of turnover achieved during the year and an additional incentive for achieving EBITDA in excess of 15% turnover. Now here basically the remuneration of the chief operating officer is based on what? It is based on your turnover and additional incentive based on EBITDA, which means what? Higher turnover, more incentive. Higher EBITDA, more incentive. Okay. Then Astra Limited has sold fiber optic cables amounting to 2 crores, invoice dated 31st March of year 2, to Ethernet Bullet Limited, a company providing high-speed internet connectivity services through fiber optic cables as well as a dedicated lease line. So they have sold to whom? Invoice is dated 31st March to Ethernet Bullet Limited. The service unit of Ethernet Bullet Limited is located next to the factory of Astra Limited. Though the goods were not moved to Ethernet Bullets Limited service unit, Astra Limited recognized the sale for the year based on the contention that the service unit is adjacent and hence the transfer can happen within few minutes. Tell me, is the risk and reward transferred? No. The risk and reward is transferred, or the performance obligation is completed only when the goods are delivered to the customer's location. Just because it is next door doesn't mean I can recognize sale. Okay. Annual results are due for board approval for the year ending 31st March and require the sign off of Mr. Dasgupta. Ms. Dasgupta. Ms. Dasgupta has been given a 40% increment on joining Astra Limited, which enables her to comfortably pay off her housing loan mortgage every month. Now here there is some kind of interest conflict. There is an interest that I have joined the company because I have a financial problem. I have joined the company and now can I approve this transaction? Because I have got a 40% increment. If I don't approve of this transaction, maybe I'll be asked to leave the company. Okay, so that is what is the thing. Additionally, she is also given perquisites in the form of business class travel, chauffeur-driven cars, stock options of the company. So, luxurious life. Accordingly, she has stated that she cannot afford to lose this job as the salary and perquisites are among the best in the country. So here, what has happened? There is a threat to independence. Why? Because there is a fear or there is a pressure, because if you do not declare the results, then the company may fire you, and if the company fires the person, she will not be able to get this extra money. She will not be able to enjoy all of these benefits. So that is why she is scared. Mrs. Srinivasan has communicated to Das Gupta that many more benefits will accrue if she agrees to present the numbers without any modification, indirect way of bribing. She has also said that company would not hesitate to replace Das Gupta should she disagree with the contentions above. So basically, open threat. There is a threat to independence. Do this or leave the company. Do this or leave the company. Okay. Discuss the potential conflicts which are arising in above scenario and the ethical principles that Mrs. Dasgupta, that Ms. Suparna Dasgupta in responding to this current situation. Now we are talking about whom? We are talking about a chartered accountant. Okay. Now here, first thing that we have to understand in this given scenario is that what is the technical context? What is wrong here? As per Ind AS 115, you will recognize revenue only when the performance obligation is satisfied. Performance obligation is satisfied when the goods are delivered to the customer's premise. Now here, the goods are not delivered to customer premise and hence we should not be recognizing the additional revenue. Now why does the company want to recognize extra revenue? They have an incentive. Higher turnover, additional incentive. Higher EBITDA, additional incentive. So there is a threat of material misstatement because the COO wants a higher revenue. Right. Now here we cannot recognize the sale of the optic fiber cable on 31st March of year 2 because the goods have not been transferred. Right. So because just imagine, no, if there is some kind of fire or if there is some kind of damage to the goods, the customer will not accept it because goods have not been delivered to the customer. So here what is happening? Here it is an overstatement of revenue. That is the core issue. Now what is the ethical issue here? Here the ethical issue is there is a conflict of interest, there is a personal interest, there is a pressure on the chartered accountant to present favorable numbers. Okay, so there is a personal issue, there is a personal conflict that the CA is going through, the chartered accountant is going through, right? So now one ethical issue is there is a pressure to present higher revenue. Second is the directors and the management, they are not providing clear or true picture to the shareholders and the stakeholders. So the company, the management must always provide proper, they must provide true pictures, true information to the, what do you call, to the stakeholders. Now the question is potential conflict. One is there is a pressure. Second one is there is an ethical duty towards the various stakeholders. Okay, and and you are required to discuss ethical principle that would guide Mrs. Suparna Das Gupta in responding to the situation. Now, what is that the chartered accountant is supposed to do? Now, the chartered accountant is supposed to act diligently. They are supposed to act ethically, right? So, what you have to do, you should be unbiased, even if there is a conflict of interest. What you have to do, you have to figure out, is there a way in which you can communicate that with those charged with governance? Okay, if you cannot reach out to those charged with governance, then you may have to take help of appropriate legal counsel, a lawyer, or the CA institute. So that is how we have to provide it. Then you also need to explain about what is explained as a part of your part 2 of the second schedule, under the clause 1 of part 2 of the second schedule, where you contravene any provisions which are given by the council, and as per the council guidelines, you will exercise due diligence and shall not be grossly negligent of the duty. So basically, you have to maintain your ethical aspect. You should not agree to the pressure, and if it is not possible, if you are under too much of pressure, then you should reach out to the higher authorities in the organization, or to the ethical board of the institute, or to an external lawyer, right? So that is how you have to answer. Detailed answer you can actually read through it. That is a simple, more of a theoretical explanation. And I have told this in the class also. It is not possible for us to remember everything. Okay, it is not possible for us to remember everything. So what you need to do is, if you are handling these kind of questions in the examination, try to present as many pointers as possible rather than focusing on remembering everything by heart, right? So that was on this particular question. Then moving to the next part on Ind AS 12. Joy Limited wishes to calculate tax base of its assets and liabilities as on 31st March of year 5. Balance sheet has been adjusted by current tax expense. So current tax expense is already provided. Summarized balance sheet on 31st March. PPE 12 lakhs. Intangible asset product development cost 60,000. Investment in subsidiary 440. Trade investment, trade receivable, inventories, cash and cash equivalents. Share capital, accumulated profits, revaluation surplus. Deferred income, liability for product warranty cost. Deferred tax liability from previous year 22162. We are on which year? 31st March of year 5. Okay. Current liabilities, trade payable 764, healthcare 70 for employees. Current tax liability 8400 is already provided. Depreciation expense for the year 4-5 allowable in accordance with tax laws is 2,06,000. Accounting depreciation included in operating cost is 1,70,000. Cost of PPE is 16 lakhs. And they have deducted an expense of 4,16,000 in its tax return prior to the financial year 4 year 5. Moreover, as on 31st March, for the first time revalued its property, plant and equipment to fair value of 12 lakhs. Revaluation surplus is 88 lakhs. Now here what has happened? Currently the carrying amount is 12 lakhs. Currently the carrying amount is 12 lakhs. Now out of this 12 lakhs, we have to see what is the tax base, then what is the temporary difference, and then based on the temporary difference, what is the value for tax purpose, and based on the temporary difference, we have to see whether it is a DTL or a DTA, and then see what is the value for tax purpose. Now, value as per books is how much? 12 lakhs. This is the carrying amount. What is the tax base? Tax base is 16 lakhs minus 4,16,000 minus 2,06,000. So what you have to do? 16 lakhs minus 4.16 minus 2.06. What you will get? You will get the tax base. Okay. Now, tax base is lower than the carrying amount. If the tax base is lower than the carrying amount, means you will be charged or you will be given lesser depreciation in future. It will be taxable. You'll have higher taxable income. So whatever is the difference you get, you can do your calculations on your own. 16 minus 4.16 minus 2.06, the difference that you get, that is a taxable temporary difference. You'll multiply that with the tax rate, whatever is given, they have given at the end, I guess, yeah, 32%. That will be your, what do you call, the deferred tax liability that you need to provide. Okay, then Joy Limited incurred product development cost of 1 lakh. These costs were recognized as an asset being amortized over useful life of 10 years. For tax period purpose, Joy Limited deducted full product development cost in year 1, year 2. Means what? In year 1, year 2, we incurred 1 lakh. Okay. Now it is how much? It has a useful life of 10 years. Tax purpose, it is fully written off in year 1, year 2. So tax base is 0. 10 years in year 1, year 2. So year 2, year 3, year 4, year 5. 4 years have been completed. So 1 lakh into 4 is done, 4 out of 10, 40,000 is done, which means 60,000 is left. So 60,000 is the carrying amount, 0 is the tax base, whatever is the difference will create a DTA. Okay. Trading investments were acquired in year 3, year 4 with cost of 2,30,000. These investments are classified at fair value through P&L and recognized at fair value. So fair value through P&L, what is the investment value? 2,08,000. So 2,08,000 and 2,30,000 means carrying amount of asset is 2,08,000. In the income tax purpose, for the income tax purpose, it is 2,30,000. So if the asset amount is lower in the carrying amount, higher for tax purpose, this will become a deductible thing. Whatever is the difference will create a DTA. Okay. Then bad debt provision amounts to 1,30,000 and relates to two debtors. Debtor A, 80,000. Receivable originated in year 2, year 3. 100% provision was recognized in year 3, year 4. Debtor B, 50,000. Receivable originated in year 3, year 4. 100% provision was recognized in year 4, year 5. So this is slightly complicated, where you also need to have a knowledge of what is allowed for tax purpose. Please understand, provision for bad debt is not allowed for income tax. For income tax purpose, you have to actually write off the debtor. You have to actually write off the debtor, and that will be the amount for the tax purpose. Okay. So provision of 130, this will not allow. Provision for 130 will not be allowed. Tax laws allow 20% of provision for debtors overdue for more than 1 year, and another 30% of debtors overdue for more than 2 years, and 50% for debtors overdue for 3 years. Okay, so what they have said is 20%, 30% and 50%. If it is more than 1 year, take 20%. If more than 2 years, take additional 30, means 20 plus 30. More than 3 years, 30 plus 50, that is 100. So that is how they will be allowed for tax purpose. Now, what is the gross amount? Gross amount is 626, that is as per the balance sheet, plus the provision for bad debt of 130. 626 plus 130, how much is that? 756. This is the gross amount. Okay. Now, this is the gross amount. How much will be allowed for tax purpose? For tax purpose, they said debtor A 80,000. Receivable originated in year 2, year 3. Okay. Receivable originated in year 2, year 3 means whatever you make provision, 80,000 is the debtor. 80,000 originated in year 2, year 3. 1 year when it passes by, you can claim 20%. Then 2 years when it passes by, you can claim another 30%. So 2, 3 it was originated. So in 3, 4 and 4, 5. So for debtor A, 80,000 into 50%. First year and second year. Sorry, second. Year 2, year 3 and year 3, year 4. So 20% greater than 1 year, 30% for the second year. So 50% you will charge, that is 40,000. For the second debtor 50,000 originated in 3, 4, what you will do? 80,000. Only for year 4, year 5, 20% is that you will be charged, right? So that will be 16,000. Sorry, 80,000 into, not 80,000, 50,000. 50,000 into 20%, 10,000. So total allowed for the purpose of tax is how much? 50,000. So 756 minus 50, 706 is the tax base. 706 is the tax base. What is our base? See, for our base, carrying amount is this only. So ours is 626. Sorry, I'll just sip some water. So carrying amount for us will be 626 only, and what we have calculated here, 706 will be for the tax base. Means tax base is higher. If for tax base an asset is higher, for tax base of an asset is higher, then it is deductible. You will create a deferred tax asset, right? Government grants are not taxable. Government grant received in 4.5 is appearing in the balance sheet. Now what I have said, government grant, as far as government grant is concerned, government grants are not taxable at all, right? Now, if government grants are not taxable, then they will not have any impact on deferred tax asset or deferred tax liability. Joy Limited accounts for inventory obsolescence provision. New provision created year 4.5 was 10,800. Total provision 18,000. Provision is not tax deductible as it is a general provision. So, when it comes to provision for inventories, right? Now, what has happened? You have deducted a provision for inventories of a total of 18,000. What is the balance in the books? Balance in the books is 3,04,000. For tax, how much will it be? Plus 18,000, 3,22,000. So, for 3,22,000, there will not be any, the difference, whatever is there, on that you will have a deferred tax implication. Because tax amount is higher, it will create a DTA. Okay, then Joy Limited made provision for product warranty of 5,000. Product warranty costs are not tax deductible until the claims are paid or settled. During the year, warranty claims were paid settled for 6,200. So, you paid 6,200. Provision is how much? You have created a provision of 5,000 in the current period. You created a provision for 5,000 in the current period. You have settled 6,200. Right? Now, product warranty cost, how much is there? Liability for product warranty cost 16,000. Now that provision, whatever is there totally, that will not be allowed. So though you have a liability of 16,000, tax purpose it is 0 only. Sir, what about this 6,200? That will be actually allowed. So while calculating your current tax, you would have actually already considered, and to determine this 16,000, you would have already accounted for this. So whatever is the difference between the warranty expenses, that will not be allowed. In future, when it is allowed, that time it will become tax deductible. So DTA. Then year 4 year 5, they introduced healthcare benefit for employees. Expenses are allowed as deduction only when the benefits are paid, but in line with Ind AS 19, such liability is recognized in P&L when employees provide service. So similar to the previous adjustment. Whatever is the healthcare benefit provision, how much is that? 70,000. That 70,000 of healthcare benefit for the employees, the tax base is 0 because it is not allowed, right? It is allowed only on the basis of payment. So subsequently, when the payment happens, at that point of time, it will be deducted. Right now, I have a liability of 70,000 as carrying amount. Tax base is nil, so this will be creating a DTA for the future, right? So what you can do for all these differences, you can multiply that with 32%, and you can solve the answer, get the deferred tax asset. Now, next question on Ind AS 23, that is borrowing cost. PQR Limited is engaged in tourism business in India. The company has planned to construct a holiday resort qualifying asset at Shimla. Cost of project has been met out of borrowed funds of 100 lakhs at the rate of 12% per annum. 40 lakhs were disbursed on 1st of April. Balance of 60 lakhs were disbursed on 1st of June. Site planning commenced on 1st of June. Since the chief engineering of the project was on medical leave, so actual work started on 1st of June. The company commenced physical construction on 1st of July. and the work of construction continued till 30th September. So when did they start construction? 1st of July. But work actually started on 1st of June. So this becomes our effective date for capitalization, right? Then till 30th September, and thereafter construction activities stopped due to landslide on the road, which leads to the construction site. So because of the landslide, you could not carry out the work. The road blockages have been cleared by government machinery on 31st December. Construction resumed on 1st of January and completed on 28th of February. So what has happened is you started multiple dates. 1st of April when you borrowed, 1st of June planning started, 1st of July construction started, 30th of September construction stopped, again 1st of January it started, and 28th of February you completed. Date of opening has been scheduled for 1st of March, but unfortunately district administration gave permission for opening on 16th March due to lack of safety measures like fire extinguisher, which has not been installed by them. Now this is a minor thing, right? So we'll see if any additional information is there. Determine the amount of borrowing cost to be capitalized towards construction of the resort if landslide is not common in Shimla, and delay in approval from the DAO is a minor administrative work. Landslide is common in Shimla and delay in approval is a major administrative work left over. So what do we know? If the building or if the project is substantially completed, then we have to stop, or there is a cessation of capitalization, what we call, right? So to capitalize, we need to incur expenditure for the asset, we need to incur the borrowing cost, and we have to undertake necessary activities. Now, if landslide is not common in Shimla, then whatever is the interruption during the construction period, that part we will not capitalize the borrowing cost. Meaning to say, just see this. See, from 1st of April to 1st of June, anyway nothing has happened. From 1st of June or 1st of July, it is 1 month. July, August, September, 3 months. October, November, December, 3 months. January, February, 2 months. Right. Now, if this interruption is unknown, it doesn't happen commonly, then in that period we will stop our capitalization activity. So what we will do, we'll capitalize for 1 plus 3, 4 plus 2, 6 months period only we will capitalize. Okay. Then, if landslide is common in Shimla, then what we will do, we will also consider the 3 months extra period, and for 9 months we will capitalize. Plus, the question says, approval is also a major administrative work. So that 15 days delay from 1st of March till 16th of March, that 15 days delay or half month extra delay also will consider, and we will capitalize for 9.5 months. So two scenarios. If the landslides are not common, then this part we will exclude and we will capitalize only for 6 months. If landslide is common and the approval is also a major work, then 6 plus 3, 9 plus half month, 9.5 months. So how will we calculate? We will take the total amount spent, 40 lakhs plus 60 lakhs, 100 lakhs, into 12% per annum, 12 by 100, into, in the first scenario, 6 by 12, in the second scenario, 9.5 by 12. Okay, so that is how we will calculate. Then the question number 15, in days 10, events occurring after the balance sheet date, and in days 109. Company has made sales of 60 lakhs to a customer SSLLP on 31st of December. Normal credit is for 1 month. However, it goes up to 2 months sometimes. Company expects to receive the payment by 28th of February of year 3. However, no payment has been received till 31st of March of year 3. On 15th April, the sales department of the company became aware that the customer is passing through financial crisis and has major cash flow problem. The company agreed to allow the customer to settle the debt by 31st of March, by which time the customer is confident that the cash flow problem will be resolved. Company expects that an annual interest of 9% can be received against any money lent, yet it allowed the customer an interest-free payment period. Normally, you allow only 2 months and 1 month. Now we have allowed how much? We have allowed a 12 months interest-free period, right? That is the first part. Then, determine the amount to be shown as trade receivable from SSLLP in the books as on 31st March of year 3. Okay. Now, what has happened? Now, they have not said, though they have said the question is on events occurring after the balance sheet, they have not said when have they finalized the account. So, we have to assume that in this case, the financial statement have not been approved till 15th of April. You're supposed to pay by 2 months. So from 31st December, you should pay by 28th of February, but you have not paid till 31st of March, which means there is definitely some kind of financial crisis. And that evidence is confirmed on 15th of April. So what you have to do? You have to back work and you have to restate the financial statement, right? Then when are you expected to receive the amount now? You have sold for 60 lakhs. This 60 lakhs you will receive after 1 year. Now here, when it is credit impaired, now here when you say 60 lakhs as per Ind AS 109, the customer is not paying the amount. When the customer is not paying the amount, that means it is credit impaired. If it is credit impaired, then what you have to do? You have to see what is the assets carrying amount and what is the present value of the cash flow. So you'll receive this on after 1 year. What is the present value? It says 9%. So if you have to determine the present value of cash flow divided by 1.09, 60 lakhs divided by 1.09, you get how much? 55.0458. 55.0458. 60, 1, 2, 1, 2, 3 divided by 1.09. 587. This is the present value. Okay. And what is the gross carrying amount? Gross carrying amount is 60 lakhs. Right? So what you have to do is, you have to measure the asset now at 55 lakhs 4,587 as on which date? You will recognize this as on 31st of March. What happens to the difference? This difference you will consider to be an impairment loss. Whatever is the difference comes to, that is an impairment loss. And in the next year, when you actually receive 60 lakhs, you will recognize an interest income. Basically what you are doing is, you are considering this to be an indirect way of financing. You are considering this to be an indirect way of financing. Okay. Then Ind AS 2 on inventories. Stock. B Limited has valued its stock held for distribution as free items on claim by customers at 0. So basically, you give some stock as distribution for free. Whenever a customer claims something, you will give it for free. Now, if you are giving it for free, are you getting any value for that? No. If you are not getting any value for that, then the NRV becomes 0. So they are saying our NRV is equal to 0. Customers have a right to claim within the 14 days period. Otherwise, the claim is foregone. Okay. Majority of free items require online registration by the buyers in the contest conducted by the respective brand, which needs to be done by the buyers within 3 days. Okay. Out of it, few items under this category were found damaged. So there is a damage in the free items. Replacement cost is 250. Now already I am valuing it at 0. That 0 thing also has got damaged, and now I have to incur a cost of 2,50,000. Determine whether the entity has to book loss of inventory or provide for replacement cost of the goods that need to be given as free items to the customer as per principles of finance. Now, if you refer to Ind AS 2, Ind AS 2 see you are already valuing the inventory at how much? 0. Now, if you have already written off something at 0, then you don't need to book any further loss on the inventory because inventory will not be negative. But what happens is, you will have to procure goods for 2,50,000. You will have to spend 2,50,000 because this inventory is damaged. For that, you need to make a provision. Okay. So whatever goods you need to procure afresh, for that you need to make a provision. You need to recognize an expense, but you don't need to book a loss on the existing inventory. Right? Then cash flow statement, pretty simple and straightforward. You can have a look at it on your own. Just that one specific aspect is here. Current liabilities include capital creditors of 25 lakhs. So, and property, plant and equipment purchased during the year is 100 lakhs. Okay. Now here what has happened is, you have purchased for 100 lakhs, but 25 liability is already there. So basically, 100 lakhs you have purchased, 25 lakhs is already there as on 31st March of year 3. Basically, you have paid only 75 lakhs. So that is one thing you have to keep in mind when you are adjusting. And this 25 lakhs of creditors from your trade payables, I think it's there in trade payables. Yeah, trade payables. When you do the adjustment, what you have to do is, you have to exclude that 25. So basically, this is 450, this is 455. Out of this 455, 25 is towards what? Capital creditors. So we will exclude these capital creditors and do the calculations. Then, a property sale, Ind AS 115, sale contract includes the following. So property sale means buying and selling of property or a company selling a constructed property. Common areas, construction services, property management services, golf membership, car park, land entitlement. So basically what happens is when you buy a flat in a township, let's say there are different blocks. Okay, there are 4 blocks and there are different apartments is there. This part here is your open area or common area where you have this child play area. Then you will have common area in front of the left. You'll have common area as corridors, right? Those are called common areas because that is not given to a specific flat. Also, on this land, the person who has purchased a flat has got something called as undivided interest. Means, let us say this township has 100 flats and this township has, for example, let us say 10 acres. It will not be the case in today's time, but just for example, 100 flats and 10 acres is the plot size. Now what happens is each flat will, if they are of equal size, will have a right over 0.1 acre. Means when you are buying a flat, you also have an ownership right. To what extent? 0.1 acre of the land. But it is undivided. Means you cannot go and say, I will sell this 0.1 acre of land. That belongs to me. That is not there. In the common pool, you have 0.1 acre right. Okay. So that is also sold along with the flat. And then companies also sell car parking facility, clubhouse, swimming pool facilities. All of those are sold. We call them as amenities. So you have common areas, lift lobbies, child play area and all of that. Construction services and building material, because on the land a building has been constructed. Property management services. Subsequently, the builder will manage the property. That is also sold. Golf membership. So this, oops, my pencil has gone. So I'll just read this out. Golf membership. Now when we say golf membership, what do we mean by that? Golf membership means they are providing some other membership. Okay. Car parking within the society. Land entitlement, undivided share of land. Okay. Whether they could be considered as separate performance obligation. Now, to answer this question, you have to see whether there is a separate performance obligation. Now, for something to be a separate performance obligation, what do we need to understand? First, the goods or service that are being transferred, they are identifiable separately from the other promises in the contract. Correct? So, in the contract, I should be able to separately identify. Now, for example, can I identify land entitlement separately? Yes. Can I identify car parking separately? Yes. That is the first thing. Second, very important condition, the customer must be able to benefit from that separate goods or service either on own or with other resources that are readily available. Now, if I have to ask you, if you buy a flat and you are entitled to this land, share of land, can you say that I will sell off that land separately? You cannot. Can you say I will not buy this land, I will buy only the flat? That is also not possible. So, though we can separately identify, there is a land separately, there is a car parking separately, you have to see which all things are separately identifiable from other promises and can I benefit from the goods or service separately, right? Now, first, common areas. Now, common areas means what? Areas in front of the left, in the corridors, in the open play area, that you cannot enjoy separately. You cannot say that, I'll take that benefit separately because that is an integral part of the land. Okay. So, generally, you don't see flats and all which are separately sold. They are generally presented as a undivided share. So, in the entire society, you'll have some, undivided share in the overall properties, in the common areas and all of that. That is not separately identifiable to a specific flat. So, that cannot be a separate performance obligation. Then, construction services and building material. Now, can you say, I can separately identify building materials? No, you have been sold a flat. So, that also is not a separate performance obligation. Property management services. Now, property management service is a subsequent service provided which the customer will be able to enjoy separately. Okay, so these are generally provided separately and these are subsequent service. Okay, now that the customer will take benefit or customer will be benefited independently. So in that case, that can be, it can be a separate performance obligation. But a lot of time what happens is these property management services also in the initial period, these are mandatory and it is bundled, but these are related to separate promises. I will transfer the society, I will transfer the flat, I will also provide property management services. So that is a separate performance obligation. Same way, golf membership, that is again a separate performance obligation because customer can enjoy that separately. Okay, then car parking and land entitlement. Now, car parking, when it comes to car parking, these are the things which you can use separately. Even if you don't take that, you will be able to buy the property. So car parking is a distinct separate performance, separate property ownership that is being transferred. But generally what happens is, when you say that car parking which is identified and you can sell it independently, so that can be considered to be a separate performance obligation, but we again need to have more information on this so that we can make a proper conclusion. Same way, land entitlement. Now when it comes to land entitlement, generally it's an integral part of the property transfer thing. You cannot say that I'll enjoy the land separately, that is not possible. So that cannot be a separate performance obligation, right? So that is one thing. Then I'll just take a minute to charge the pencil and then we'll again continue. Then Index 110 on consolidated financial statement. At the beginning of its current financial year, AB Limited holds 90% equity interest in BC Limited. So AB holds 90% in BC Limited. During the financial year, AB Limited sells 70% of its equity interest in BC Limited to PQR Limited for 56 crores. Means what? Out of 90%, after the stake 70 is sold, means control is lost, and consequently loses control of BC Limited. At the date of disposal, fair value of 20% interest retained by AB Limited is 16 crores, and the net asset of BC Limited are fair valued at 60 crores. Okay. These net assets include the following: debt investment classified as FVT OCI of 12 crore and related FVOCI reserve 6 crore. So this is one thing, you have FVOCI reserve of 6 crore. Net defined benefit liability of 6 crores and resulted in a reserve relating to the net measurement losses of 3 crore. This is also in OCI. Equity investment of 10 crores for which irrevocable option of recognizing the changes in fair value in FVOCI has been availed and related FVOCI reserve is 4 crores. So what are these net assets? These are the net assets of subsidiary. Now please understand, for the subsidiary you will recognize debt separately, you will also recognize this related FVOCI. Liability separately, related OCI, and similarly equity investment separately, OCI separately. Net asset of a foreign operation of 20 crores and related foreign currency translation reserve of 8 crores. In consolidated financial statement, AB Limited, 90% of the reserves were included in equivalent equity reserves, with the 10% attributable to NCI included as a part of the carrying amount of the NCI. What would be the accounting treatment on loss of control in the consolidated financial statement? Now here, it's a very straightforward question. First is, whenever there is a loss of control, what you will do? You will de-recognize the net assets. You will recognize residual interest. You will also de-recognize the non-controlling interest, right? So what you will do? You will de-recognize net assets, so you will credit net assets 60 crores. You will de-recognize NCI. What is NCI? NCI is 10%. So you will debit NCI by how much? By 10 crores. sorry, not 10 crores, 10%. So that is 6 crores. Okay. Then you have received a consideration of 56 crores. So debit, bank 56 crores. You will retain 20% interest at 16 crores. Debit, investment 16 crores. So basically if you see 15 plus 16, 72 plus 6, 78 minus 60. 56 plus 16 plus 6, that is 78 minus 60, gain is how much? 18. Okay. So gain of 18 will be recognized at the time of disposal of the subsidiary or loss of control of the subsidiary. Then what you will do? The remaining reserves, see, debt, net defined benefit liability, equity investment, net assets, all of these will be de-recognized along with this net asset. But whatever is there in FVOCI, that you have to subsequently reclassify. So debt investment classified as fair value through other comprehensive income. When you dispose of the debt investment, this 6 crores will be transferred to P&L. Now 6 crores is 100%, our share is 90%, so 5.4 will be transferred to P&L. Then net defined benefit liability 6 crores with a measurement loss of 3 crores. Now this also, when you are disposing of, this has to be transferred to your retained earnings or reserves and surplus. This will not go to P&L. Okay. How much? 3 crores into 90%, 2.7 will be taken to retained earnings. Okay. Then equity investment. Now this can be taken to reserves and surplus or other components of equity, but not to P&L. Equity investment you will de-recognize with net asset. Irrevocable option of recognizing the changes in fair value OCI has been availed. So this irrevocable option, this whatever is the balance left, that will never go to P&L. So this also will be transferred to other components of equity under retained earnings or reserves and surplus. 4 crores into 90%, 3.6. Net translation foreign currency, this can go to P&L. 7.2, 90%, this will go to P&L. So basically you will transfer them to P&L. Now the thing that you have to understand here is, these items, debt, net defined benefit liability, equity investment, net asset, these will be de-recognized along with this net asset. The reserve portion that you would have added to your respective reserves, that has to be reclassified in the consolidated P&L. Okay. Then the last one, Index 102, Fashion India Limited entered into an agreement with RFD Limited on 10th of August for purchasing a machinery. Agreement has a clause that FIL will have to settle the consideration of machinery purchased by issuing equity shares. FIL agreed to the clause and the order was confirmed. Machinery was supplied by invoice dated 25th of October and delivered on 1st of November. Agreed purchase consideration is 150 lakhs. Fair value of the machinery supplied is 160. FIL issued 1 lakh equity shares of face value of 100 each. What should be the price for recording the machinery? So now we know, whenever we are purchasing goods or services from non-employees, right? So not services from employees. Whenever we are purchasing goods or services, the idea should be to value the item which is acquired at the fair value of the item which is procured, which is 160 lakhs. So you will recognize the transaction at 160 lakhs only. You will not recognize this at 150 lakhs. Simple question. Now if you see, most of the questions are straightforward, which we have already discussed in the class. Some new concepts and MCQ especially. If you have learned the concepts, if you have practiced all the questions in the class, those would be more than sufficient for you, right? So that is it with respect to this discussion on RTP. We will soon be uploading MCQs on our app. You can get hold of them very soon. And if you have any questions on this, feel free to ask on forums. And prepare well, revise well, complete the syllabus in time. That is very, very important. And all the best for your examination. Thanks a lot for joining in and have a nice day.